Stocks our strategists feel are poised to deliver positive returns are featured now in their top stock picks of the week.
Welcome to another edition of Zacks Top Stock Picks. I'm Brian Boland. I'm the aggressive growth stock strategist here at Zacks, and I've got a top stock pick. And later on, Ben Raines is going to come on and give you his top stock pick. But let's go right to mine, shall we? Let's get into it. It's United Rentals, and the ticker for that is URI. So it's United Rentals. We can see the name here, and the ticker is URI. It's a Zacks rank number 2, B for value, B for growth. And as the name implies, this is, building products and materials, really rentals, large scale equipment rentals for businesses. Now, the reason I have this as my top stock pick of the week is because we've got earnings coming out Wednesday after the market closes. And we can see from our proprietary earnings ESP, that information is telling me that we're expecting a beat of about 5%. So we take a look at a lot of things out there, and then we've come up with our ESP number, and we are expecting a beat. We can see it is a $52 billion company. It pays a healthy dividend. Well, not really a healthy dividend. $7 isn't so healthy when it's an $800 stock. But a little bit less than 1%. So you're getting some return back on your cash every quarter, and you also get the risk premium in there. All right, so let's go to the numbers that I always look at as an investor. Are you beating the number? So it is yes, no, and yes. So we've got a miss sandwich, 2 misses in between, 2 beats sandwiched in between 2 beats, but low levels here, except for this one. This one was kind of a big miss. This was a small beat, so not too much to glean from that. But we're going to take a look at our estimates. Why is this a Zacks rank number 2? We can see 60 days ago, this number kicked from 1054 to 1059, and then it slipped back down. But this number for next quarter has gone from 1222 to 1230, along with a higher boost to kick back down. The full year, which the investors really care about, it's 455 going up, or 4355 going up to 4367 next year, 4757 up to 4775. So we're trending higher on our estimates, at least estimate movement. I care about growth, but this is a mature industry. $16 billion is a lot, going up to 16 3/4, 4% to almost 5%. So we've got accelerating top line growth, 1% earnings growth this year, almost 10% next year. So this could set up to be a great long-term hold. A lot of people have issues with that big dollar sign, $800. It's all about percentage gain, as we say. So you're trading at an 18.5 multiple. So that's right at the market for the most part. 6 times book. Might be a little aggressive, but they are an asset-heavy business. So I'd like to see that just a little bit higher. Price to sales, 3.37 is probably pretty good for the fact that there's a little to no moat other than a lot of capital. Margins haven't done so well, but they're okay in the upper teens there. Now let's go to the chart and see what this can tell us. All right, so the pandemic was back over here. We're all going to die, but no, we're actually going to start building things. There's all kind of stimulus. This didn't get affected by the tech wreck. And then we run into the election cycle and we're going, we're going to go great, but maybe not. Maybe tariffs are a terrible thing. And then a rebound here. So that's what your stock pattern over the big news has told you. Now let's take a look at this. Got those 2 misses, and then these 2 misses, and then these 2 misses. So, I don't want to say that this is scientific in any way, but you miss 2 quarters and you beat for 4. You miss 2 quarters and you beat for 2, 3, 4, 5. You miss 2 quarters and this is the beat. So you got to imagine there's 3 beats, 4 beats coming in a row, maybe. I would like to see that, especially if this big, beautiful bill works for construction players and things like that. So Wednesday after the close, you've got United Rentals reporting earnings. All right, that's it for me right now. I'm going to hand this off to Ben Raines for his great top stock pick for this week.
Thanks, Brian. Hello, everybody. I'm Ben Raines. For my top stock pick of the week at Zacks, I'm looking at Intuit, which trades in the ticker INTU. Intuit stock soared to all-time highs after the TurboTax owner posted a big beat and raise third quarter of 2025 back in late May, boosted by its artificial intelligence efforts, which are really paying off for the stock. The technology giant finally broke out of a trading range it had been stuck in since late 2021. Wall Street's increasingly convinced that Intuit's expanding portfolio in AI enhancements will keep it churning out double-digit sales earnings growth going forward. Intuit stock has also crushed the tech sector and the software standouts such as Microsoft over the past 20 years. So let's dive into kind of a bit more of the bull case before we look into some of the charts and estimates. So Intuit is one of the biggest players in a quarter of the economy. It's never going out of style. That's taxes. The company's essential and timeless software offerings have helped it consistently post top-line expansion that's impressive even among kind of its mega-cap tech peers like Apple and Microsoft and Alphabet. It averaged 16% revenue growth over the last decade, along with 15% GAAP earnings expansion. It expanded its software portfolio far beyond TurboTax to become kind of a one-stop shop for business and consumer finance. It also has email marketing and digital ad services. So that's via Credit Karma, QuickBooks, and MailChimp. The tech standout boasts that has roughly 100 million customers across its various businesses. And more importantly, and once again, this is kind of a big reason it jumped last quarter, it's ready to fight off any potential new age challengers by going kind of all in on artificial intelligence. Last summer, it cemented its AI efforts as it attempts to roll out next generation tech into every pocket of its business. It's also reshaping its assisted tax preparation segment by leveraging its AI expert platform to offer kind of scalable, cost-effective alternatives. So just quickly looking at its most recent quarter back in May, it posted a big beat and raise third quarter. Its AI-powered innovations and personalized offerings spurred that growth. So its AI-powered TurboTax Live, which is an assisted tax preparation service that combines humans and with AI automation, saw its revenue climb nearly 50%, which represented 40% of its total global or consumer group revenue. So now we're going to go over to our Zacks.com and our ZRS system to kind of look at some more charts and estimates for Intuit. Okay, so before we jump into our Zacks.com ticker page for Intuit and then look at our ZRS system, I quickly just want to show Intuit's website for anyone who might not be familiar with some of their products. You can see they now have 4 core businesses: TurboTax, Credit Karma, QuickBooks, and MailChimp, offering a ton of different products. So there's the Intuit Assist, which is part of this big AI effort. So this is what they highlighted a lot in the last quarter. So just worth, if you're obviously anybody going to consider buying the stock, maybe peruse the website and look at a little bit more what their offerings are. But the growth is really stellar. So we'll take a quick look at the Zacks.com page, the ticker page. So we can see Intuit is the Zacks rank number 1 strong buy here at the moment. And it's in the top 15% of over 240 Zacks industries, which is a great sign since being part of a top half industry is really important for a stock. And we're going to go take a look now at our detailed estimates. So as I mentioned up top, it's posted consistent 16% average revenue growth over the last decade. We're calling for another 15% revenue growth in 2025, which it's on a different system. So that's ending in July to get all the way up to about 18.7 billion, and then do another 12% growth next year to get up to about 21 billion. And then on the bottom line, we're calling for 18.5% adjusted earnings growth this year, and then another 14% next year. And since that big beat raise quarter, we've seen its estimates kind of go straight up from there. It has a really impressive history of bottom line beats, being an average of 12% in the last 4 quarters. And we can take a look. This is our snapshot page. We can see that that's the big boost for its earnings had kind of flatlined, or its earnings growth estimates had flatlined. So these big spikes are the most recent quarter, as I mentioned, that Q3, which is a really great sign. But we can go ahead and take a look. Same chart there as well, just to give investors a sense of where its earnings are going. And then we can see out of the 30 brokerage recommendations, we have 23 are sitting at strong buys, with 3 buys, 3 holds, and only 1 strong sell. So Wall Street's still really high on the stock for kind of all the reasons we mentioned up top already. This is its performance over the last 20 years. The stock's up over 3,000%, blowing away the broader tech sector, which is up around 800%. We can now put this back to 5 years. So we can see, as I mentioned, it had been stuck in this trading range. It tried to break out above its all-time highs a few times in 2024, and then it finally broke out meaningfully above that level after its Q3 report. So we can show this right here. So this is the green arrow after its big beat raise on May 22nd, finally jumped up and climbed above those previous 2021 peaks. It has fallen back a little bit recently. We can see that it has slipped a bit. It's trading around 4% below its recent all-time highs, but it's still more than double tech so far in 2025. We can take a look at our technical chart here as well. So it's currently trading in between its 50-day and 21-day moving averages. And scoot this out to, say, a 10-year chart. You can see that shorter-term 21-week moving average moved above the longer-term 50-week, which is a positive sign with the shorter dated trend line moving above the longer dated trend line. And we can see that it finally broke above that level here. So that's the line that bulls will try to hold heading into its Q4 release in the next month or so. So this is that line that said those previous 2021 highs. If it fades back to maybe 21-week or 50-week moving average, that would be a better entry point for technical traders or traders in general, but longer-term investors shouldn't worry too much about that. Then we could take a look at the valuation side as well quickly, with the stock trading just roughly 3 to 4% below its all-time highs. It's trading at well over 40% below its highs in terms of forward earnings. Still obviously trading well above the tech sector, but investors have been willing to pay up for Intuit for a long time because of that consistent growth outlook. And it's trading at roughly its 10, not too far above its 10-year median. And then if you look at its PEG ratio here, we take a look at that, showing a similar trend here as well. So it's trading at a premium to tech, but it's been worth it. And it's trading right near its 10-year median, even though the stock's trading right near its all-time highs. All right, so as we talked about a little bit, Intuit stock has pulled back a bit recently off those all-time highs. So some investors might want to scoop it up at a slightly lower and more attractive entry point. Maybe you want to wait for the company to report its Q4 earnings results. But longer-term investors shouldn't try to time the stock exactly, since you could be left kind of waiting on the sidelines and waiting for the so-called perfect time on this market-crushing tech stock that boasts consistent growth outlook boosted by those AI efforts. So that does it for me in this episode of Top Stock Picks here at Zacks. Please head over to zacks.com/promo page for a look at our services, portfolios, and